like if you want me to do something, or you can just ask me too. I'll be here.
Okay.
I think it's pretty mellow. Okay. And Steve is on here, but I don't hear him or see him.
Looks like you just, okay. He was on there for a minute.
Steve?
Live and in person.
There you go. We're going live in 5 seconds.
Okay.
Welcome, everybody. Steve, take it away.
Welcome, everyone. Welcome to Cost Segregation. And I'm really excited about this because this saves you taxes. I love saving taxes. And what happens with it is it deals with the time value of money. That's how banks make all their money, with the time value of money. So essentially, we're going to show you today how we'll take something as mundane as depreciation, which most things are depreciated, real property, over either 39 years or 27 and a half years, and how we can accelerate that. So what that means in English is that instead of having checks to the IRS and state for your taxes, you have a great tax savings, and then you can do whatever you want with that money, including investing it and earning on it. And just think about it. Instead of paying money to the government, you're investing that money for yourself. And also, this is approved by the government. We've been doing this for a long time. We're tax attorneys, and we work together with a very prestigious company that specializes in the cost segregation. We've worked together many years. We've done many, many of these. We have dramatic results. We have clients that save hundreds of thousands of dollars a year. And over all these years, has the IRS ever said, hey, what are you guys doing? A few times they have. And we have a perfect record. And the reason we have a perfect record, this is statutory. It's not that we dreamed up some scheme and tortured some case. This is statutory. By law, we're entitled to do it. And you say, oh, that's wonderful, but my God, I didn't buy a building this year. I bought it last year, and I'm using that 39. I'm using that 27 and a half. What am I going to do? Oh, no, oh, no. The answer is no problem. It's called a change of accounting method. We come in, and we go ahead and we change it. So what's the mystery here? What's the magic? Well, here's what happens. We say, okay, we send an engineer to your property, and he or she will go over the property and say, okay, now this portion is 39 or 27 and a half year property, but this portion is 15-year property. This portion is 10-year property. This portion's 5-year property. And this portion, we can write the whole thing off right now, today. And under the last Tax Act, we had a tremendous benefit where something called bonus depreciation was stepped up from 50% to 100%. Isn't that wonderful? However, there's been a change in administration, and it's believed that the administration wants to go back and drop it back from 100 to 50. So what that means is you can do it right now. There's a reason to say, hey, guys, do it right now. You don't want to say, that's a great idea, wait a while, contact us. Yeah, it is a great idea. We can still take 50%, not 100. Let's go ahead and let's get it all now. So the bottom line is, for those of you that know me, I get very excited when I talk about tax. But we want to go ahead, doesn't everybody? But what we're going to do is we're going to go ahead and talk to you about what are the details with this. And I want to go ahead and turn the floor over to my good friend and colleague, TJ Leonard. TJ, wow us.
Thanks, Steve. I appreciate the introduction, and I think what Steve just said is right on. Especially right now is the absolute time to do this. And to piggyback on what Steve said is correct. In the former administration, it was 100% bonus depreciation. And the biggest piece to that is it didn't have to be a brand new constructed building. It could have been something that you bought that's been there for decades and decades or centuries and centuries. As long as you just newly acquired that building, it started from year one all over again. So you got 100% bonus. The new administration, as Steve mentioned, is going to revert back to 50%. And that 50% is only going to be on new construction. So if you think about it, you're actually able to double dip, if you will, right now. And that's the reason for the webinar. And that's the reason to make sure that we share the message. So I'm going to get right into it and make this as informative and as quick as possible. But just a little bit about me. Our company is Cost Segregation Services Incorporated. We partner with Moskowitz LLP, and we have for many years. We've got a great relationship, but most importantly, the clientele from Steve's firm has seen literally millions of dollars now back in their pockets. And that's what we want to be able to share with you today. So with that being said, what Steve mentioned, most folks don't realize that they can take advantage of cost segregation. There's what we call the standard line method, which pretty much most people operate under. And then there's cost segregation. It's an IRS approved method since the 90s. And it just is a matter of taking advantage of it. So this is just a quick synopsis of what that means. If you had $1 million purchase price, and if you have commercial property, that's deemed anything that isn't residential. Now, the residential, we want to clarify, that would be like multifamily property, apartment complexes, condos, or even in some cases, if you have rental homes that you rent out and you're showing income, those can qualify as well with some specifications, but they're very moderate. So with that being said, you're being able to take, if you look down here, your year 1 up to year 20, you're getting all that depreciation immediately, as opposed to having to wait upwards of 39 years. And what this is showing you is, if you do it the standard way, and you take that $1 million purchase price, your CPA is going to write off $9,400 every year. Same number over and over and over again. So if you don't keep your property for 39 or 27 and a half years, you essentially leave all that money on the table and you leave it with the IRS. And I know two things are certain: death and taxes. And I'd rather minimize my taxes and be able to have it in my pocket instead of theirs.
But also having it so early with the time value of money, $1 benefit today. Just think about it. The money that you save with TJ and with our law firm, you can invest that money. So the bottom line is, over this period of time, what you don't pay the IRS in this state is earning money for you. That's one of the really exciting parts about it. TJ is very modest.
I try to be. Cost seg is cash flow, plain and simple. We're putting money back into your pocket today. That's the gist of it. Instead of having that cash being spent or with the IRS over 27 or 39, or maybe only keep your property 15 years, this is being able to take advantage of every single dollar that's in that building. And don't get your mind wrapped around, well, I've put this, I've put that. We're simply talking about the building itself. So it doesn't matter if your business was profitable or not profitable, you still have the ability to utilize cost segregation on that building. So the highlighted portion here, the benchmark, and I'm going to let everybody kind of read on their own, because to me, when you have a webinar and you're reading things right off the screen, it just becomes mundane.
And one of the little things I would talk to you about with profits is, if you have a loss, the CARES Act changed that. And now the act before that, mostly for most businesses, took away NOLs, net operating losses. Now with the CARES Act, we can take a loss that you've generated in 2020 or 19 or 18 and actually go back 5 years to 2014. And in that 5-year period, recover taxes you paid. So the bottom line is, it's not only the potential to save money for this year, you can even get money back from previous years, and to expedite and get the money to you faster. The IRS set up a special fax line to get the money in your hands really quickly. So again, just all kinds of benefits here.
And we'll touch on that too here as well. But what I want to just say is, if you think about your building, and let's just say that you have $1 million building, it's $1 million. you're looking at roughly $60,000 to $100,000 back in actual tangible cash in your pocket for that building. I can think of a lot of ways to spend $100,000 right now. And I always tell my clients, if I gave you $100,000 to go to Vegas for the weekend and you came back with $1 million, that'd be a pretty good weekend and a pretty good net profit. That's what cost segregation is.
Without that kind of risk.
Without the risk. Since it's lunchtime, I figured why not show a hamburger? So the straight line method is your standard Big Mac, right? It's $3.99. It is what it is. It's just a line item. What cost segregation is pulling out every specific thing, including the sesame seed, and being able to say, listen, yes, you have a light bulb in your building, but does the IRS know if it's a filament light bulb, a fluorescent light bulb, or an LED light bulb? They all have different valuations, no different than the burger. We're going to pay you for the lettuce. We're going to pay you for the cheese, the pickles, the onions, and the sesame seed bun. And I know, don't ever forget about those 2 all beef patties. So a couple case studies, because really the proof is in the pudding. So I just put a few of them on here just to show kind of the complexity. But here's a self-storage building on the left. It was purchased in 2017 for close to $1 million. Their tax savings was close to $50,000. And then in 2018, here's another one with construction of $3.6 million. This one had climate control and the tax savings of $569,000. So a dental office, $1 million shell, that's just the outside. And I think the thing I want to key on here is you may also have leaseholder improvements. You may be a leaseholder and you don't own the building itself. If you have $250,000 of improvements, you qualify for cost segregation as well. So here's somebody that just had improvements of $450,000, yet they still ended up with close to $75,000 in tax savings. And then finally, multiple office complexes purchased as far back as 1999. People think that unless it, like Steve mentioned, if it hadn't been in just the last couple of years, that's not accurate. One of the benefits that we've created for Moskowitz LLP is Steve and his team can provide us with your building information, and we will complimentary go back and run the numbers for you so that Steve and his team can present them to you at no cost. So you can see what you qualify for, and then from that standpoint, decide to move forward. And Steve, the last I checked, I can't remember anybody saying no, they didn't want to move forward.
I've never had that. I mean, basically, when I talk to clients, I ask the question, would you prefer to A, decrease your taxes, or B, increase your taxes? Everybody laughs and says, well, of course. And I said, are you doing this stuff? And they say, no. I said, well, in theory, you got it right, but in reality, you're not. This is here. We can do this. And if you do it today, we can go ahead and save you taxes on your 2020 return and possibly do an NOL and go back, get money for other years too. So again, this and it's statutory. You're entitled to it. The Congress people in their infinite wisdom gave us this. And sometimes people say, well, why would we have such a benefit? Because in a democracy, there's 2 purposes for the tax law. One we all know about, get money out of us. But the other one is, in a democracy, the government can't say they order you to buy a new building or they order you to make improvements. But it's good for the economy. They want you to do it. So how do they get you to do what they want when they can't order you? They give you a tax incentive. And that's where our firm and TJ get together and say, hey, the Congress gave it, let's take it with open hands.
Yeah. And Steve, great segue there too, but here's the NOLs. And when we say NOLs, we're talking about net operating losses. Another great piece to just kind of think about after the hamburger scenario is if you bought a lottery ticket today and you won $100,000 and you had your choice, I can have my $100,000 today, or I can have the same $100,000, but I have to wait. I just get a chunk of it for 39 years. I would think everybody would want the $100,000 right now. That's what cost segregation is. Instead of getting a little bit every year, you get it all at once. So one of the nice things about the CARES Act that the Trump administration enacted was the ability to take active versus passive losses and go backwards up to 5 years and get those back. So the most important thing with that is that the rules require that your CPA firm, which is Moskowitz LLP, can go back up to 5 years. And if you qualify and you do a cost segregation study on that building, you will have a very large refund coming back to you, capturing those losses that you had before. And here in this, my little green medal, if you will, but 2020 is the last year to take advantage of this. So if you don't do anything after this webinar, at least get Steve's team the information so that we can go back and look and present you with some findings and give you the opportunity to say, I'm sitting on all this money. I didn't even realize that I was, and I can go back and capture it because of the CARES Act. There's no better time to do it.
And let me just jump in here, TJ. So
yeah, thanks.
The reason this is such big news is because the Trump Tax Act that passed at the end of 2017 actually did away with the ability to carry back losses. So this is huge. At most, in the past, we were able to go back a couple of years. Now, going back 5 years, we can generate refund checks for clients that we really didn't think would be possible. So that's something absolutely every business owner should look at their tax return this year and see if we can generate a loss, and if so, let's carry it back and get some refunds.
Absolutely. And Cliff is the head of our tax department. Cliff has over 30 years experience doing this. Cliff is a tax attorney, and we do lots and lots and lots of these, and it's so dramatic. And the thing that we start off with is TJ and our firm work together, and then we'll go to the client and say, okay, if you'd like to do this, we'll save you X number of dollars. So before you actually pull the trigger, we'll tell you, you will save X number of dollars. And as TJ was saying earlier, I've never heard anybody say, yeah, I don't want the money. I don't want the savings. But we'll tell you what it is before, and then you can pull the trigger.
Yeah, the people that say they don't want the money, I try to then buy the building from them because I'd like it. So on that notion here, TPRs is just a shortened version for tangible property regulations, and what we would all call repair regulations. And the key to this is just inside your building, or what we would consider building systems, is if you were to go in and let's say buy a building and you've got to chunk some things out or take down a wall, or make some drastic improvements, maybe put on a new roof or air conditioning unit, what have you. These help you as well because you can take advantage of the units of property, if you will. And just say as an example, you bought a building today and you were going to go have to put some improvements in it, or maybe you bought it last year, the year before, what have you. You're able to do a cost segregation per the IRS regulation in 1 year. And then all of those repair regulations you did, you can re-depreciate them as long as it's in a second year. So technically the IRS is letting us double dip and take advantage of throwaway depreciation. And it's fantastic, and it's been around since 2014. It's just a matter, once again, of taking advantage of it. It's there for us. It's allowable. Let's use it.
And one of the things I'd say about that is all the time in the newspaper, you see these Fortune 500 companies make billions with a B in profit, and they don't pay taxes. And people say, how could that possibly be legal? But it is. That's what our laws are. That's the system of incentives. But the law isn't written, here's what the Fortune 500 can do, and here's the law for everybody else. It's the same law for all of us, but you have to know about these things. And a Fortune 500 company has people like us doing all these things for them. It's the business that's smaller than the Fortune 500, the typical owner working long and hard and usually grumbling about, I'm paying too much in taxes. All of these things are available, but you have to know about them. So the bottom line is we'll do all this for you, along with lots of other good things too. And you go ahead and do what the Fortune 500 is doing.
Yeah, just a follow-up on the tangible property regulations. We also refer to them as CapEx, and that is just simply saying capitalization versus expense, where before 2014, a lot of things would get capitalized in what you can see on the screen here, your building systems or your components. And mostly it was, hey, if the client's spending over $10,000, let's capitalize it. This gives the ability to reverse that and expense it, which again turns into depreciation for you and deductions, I should say. And that's cash. It's cash back in your hand. So
Or
again,
another way to look
another
at
thing
it,
that-
capitalization bad, depreciation good.
Correct. So the Tax Cut and Jobs Act that went back to 2017, again, back in our former administration, what we started our webinars on this morning or this afternoon was on bonus depreciation. So just to qualify what that really means. September 27th of 2017 is when the Trump administration said, we're now going to change the 50% bonus to 100% bonus. And we don't care if you just purchased the building or if you just actually physically took a hammer and nails and built it yourself. As long as it's newly acquired as the key word, then you qualify for 100%. And you can see I've got that in the second piece there. So even a renovation qualifies for that. But we all believe that in this new administration, it's going to go away quickly and it may be reverted back to the first of the year, January 1 of 2021. However, what we have seen is happening now are those folks that are taking advantage of cost segregation now, and they've got an engagement letter moving forward. You've got a paper trail, your grandfather. They can't go back and change that on us. So that's, again, the reason for getting this information out to you as quickly as possible. Steve,
And I think one of the things that we want to emphasize here is with this law that we're trying to take advantage of before it goes away is that it just has to be new to you. It doesn't have to be new construction. That was a big change.
Correct. And just lastly, Cliff?
Yeah, another question I get, TJ, is, business owner says, well, I've got a lot of expensive equipment, but it's all, bolted to the floor, the wall, or it's tack welded to the floor. So I've just been depreciating that over the life of the building because it's permanent, right?
Right.
Well, what can we do about what kind of arguments would we have with regard to movability there?
Yeah, is what we would consider a part of the building is exactly what you said, Cliff, almost bolted down. So if it's bolted and it's affixed, that's part of the building. The other things would probably be more 179 in that aspect. But if it's part of that building component, and I think what Cliff is kind of leading me down the road to is one thing that we do that most companies do not, and there's lots of companies out there that do this, but they're not engineer based. And what that means is that we're going to send one of our engineers, including myself, to your property. And we're going to physically take pictures of everything on the inside, on the outside, internal components, external components, the building itself. And what that allows us to do is to be extremely finite with the IRS. We're the first company that was established doing cost segregation in the early 90s. We know where we can be extremely aggressive with them. We know where we have to be very conservative with them. And these are not auditable. This is never going to trigger an audit, and that's going to come up in my next couple slides. But there have been, I believe, 8 now instances since 1998 where 8 clients did have to go through an audit because of something else. It had nothing to do with cost segregation. But we will provide our engineer at that audit free of charge. We fly them out. We have them substantiate what we've done. And that's why we have such a great track record with the IRS.
And such a super tiny percentage being audited.
Yeah, I think we're up to 50,000 studies and 8. That's probably the same, less than 0.1%, if that. So couple bonus depreciation examples, all right? So if we look at something purchased even back in 2017, the straight line method, which is your 39-year method, it would have just been $26,000 a year. With the acceleration of cost segregation, now that 5-year property, instead of it being $26,000, now we're looking at $154,000 because we've combined all those 5 years into one, which is why you'll see this 26 jump to 154. But with the bonus depreciation, you're now adding 15 more years and pulling that forward because it incorporates 20 years of tax savings immediately. So now you've got a difference of $26,000 worth of a deduction and $700,000 worth of a deduction. And that turns into cash back in your pocket. You can either have the IRS hold it as a credit and use it over the next few years. You can have the IRS use it immediately and send you the rest in a refund check. It's really up to you. And I think most of our clients, Steve, have found that whatever they owe in that tax year, whatever their tax penalty is that they're going to have in this case for 2020, they pay their tax basically with the credit they've received, and they take the rest back in a refund. And as Steve mentioned, try to go buy another building or invest it in some way. So again, these are assets prior to 2017 in the Tax Act versus after, and you can just see some total property costs on different facilities. If you have strip malls, if you have medical complexes, if you've got multi-property, which would be multi-unit, which would be apartment complexes, condos, those trigger an extremely high depreciation through cost seg because you're constantly changing things out. If you're a landlord and you've got multi-units and people are coming and going, you're having to change things over and over. So you've got even more money than you realize. And you can kind of see here as it moves its way down, when we get into the living style or putting people in your buildings, you can see that there's far more money than just something that is maybe just an office complex with a couple walls and some desks.
Not to mention making your tenants happy.
Yeah, absolutely. Absolutely. All right. So who's this really important to? I think anybody that deals with owners, and obviously Moskowitz LLP, we've got CPAs, we've got tax attorneys, we've got real estate brokers. Again, getting back to the triple net lease tenant and landowners, cost segregation is always going to be about the building itself. We can't depreciate the land. The land is what it is, but that building itself is completely depreciable. And as I just mentioned here too, when we look at our largest beneficiaries, those things that are constantly changing as far as having to change carpets, fixtures, HVAC units, what have you, those have the largest amount of depreciation or cash back for our clients that we find. So very simple as we move forward. All you need to do is basically get back in touch with Steve's team, and then they can we'll work together and we will provide a complimentary study for you. It's a very quick 10-page study. And I know 10 pages is, I don't even want to read a 10-page book to my kids. But the first few pages is mostly about what we do as a company and how we partner with Moskowitz LLP. The informative pages are only 2. And it's going to show you what you're sitting on right now.
And we explain it to you. You don't have to read it on your own.
Yep.
You're not the engineers. We'll explain it to you in simple English.
Yeah, it really is. So this is how we work. As soon as we get that back, we kind of have just a quick little sample process, but we'll look at your tax depreciation schedule with your team. We're going to then engage at that standpoint. Once you decide that this is what you want to do moving forward, we will sign an engagement letter. We will then get any information we need through Steve's team. And all we need, honestly, is very simple. We need to know that you've either got an appraisal that's been done on it, or you've got the original blueprints, one of the two. We've helped clients that don't have either of the two because maybe they bought the building back, within the last 15 years or so. And then we just need to verify the cost basis. And that's just simply saying, hey, I bought this building for $1 million. The land was $150,000. That makes my cost basis now $850,000. And we just want to make sure we confirm that before we move forward with the study. Once we've got everything we need, then we will set up a time to do a site review. And that's myself or one of my colleagues coming out, taking a digital camera and snapping pictures very quickly of all the components that you have. If you're, let's say, in the medical field and you're thinking of, we've got HIPAA and computers and this and that, we've done a tremendous amount. We're not looking for finite details of a computer sitting on a desk. We're looking for building components and systems. So we can either do it A, when your clientele is not there, or B, when they are. We're very flexible. It's up to you. We want to get the study done as quick as possible. And then finally, it's about a 6 to 8 week process. So from that standpoint, once we've got everything we need, we're really at about a 4 to 6 week. It's very quick from that standpoint. So we could start, let's say, next week and still be able to have things done for you by April if you're going that route. Or you just simply go on extension and we have everything for you. And this way, instead of paying taxes this year to the IRS, you're keeping all your money in your pocket and you're using it where you really need it. To substantiate your business, maybe to take a vacation that you've needed, to put it back into things that you need family-wise, or finally just reinvesting it, in more property, if you will. I mentioned earlier that I don't want to trigger an audit. Cliff, I think, said it. Steve said it. And I'm sure in the industry it's heard over and over again. This is not an auditable offense, if you will. Cost segregation is an IRS-approved method. So it's never, ever, ever going to trigger an audit. I just want to make everybody aware of that.
Yeah, just to add a point on that, TJ, as you remember when the tangible property regs first came out, it was actually a requirement that everybody, every building owner, every business owner with depreciable property go through some sort of cost segregation. So it's not only approved, it's actually required by the IRS.
Yeah, great point. And I'll finish up here. And I've noticed, so we do have on the web meeting, you probably can see there's a Q&A portion and a chat portion. And I have received one question that I'll get to here quickly just to make sure everybody's aware. But just very quickly, today virtually all real property purchases entail the simultaneous acquisition of tangible property. For that reason, CPA should routinely recommend the use of cost segregation, which is exactly what we're doing here today. And this is recommended by the American Institute of Certified Professional Accountants. So finally, who are we? And I know I started that at the beginning, but let me just tell you how we got here. So this piece right here, Jim Shreve. Jim's the owner of our company. Jim was and still is, but he's an engineer and he's a CPA, but he also has a law degree. Jim was one of the founding fathers of cost segregation in the fact that he sued the IRS on behalf of the Hospital Corporations of America and Walgreens back in 1997. And the IRS lost $800 million, and they quickly realized that if we don't make this thing, which wasn't called cost segregation until that landmark case, if we don't make this a rule, then we're going to lose all this money in the IRS. So this is how cost segregation got started. And we have the founding father, and that's who owns the company. So trust that when we say we have a great working relationship with the IRS, we truly, truly do. And then just lastly, my email's here. I'll leave that up on the screen. You can certainly call me. I am Central Valley based. I have obviously Steve's firm up in San Francisco, but it does not matter if your building is in California or it's in the Netherlands. As long as you're paying taxes in the IRS and you've got a building, you qualify for cost segregation. One of the questions that was asked is, are costs related to qualified improvements of vacation rental homes eligible for the deduction? So they are. If you've got vacation rentals like Airbnbs or VRBOs, those do qualify. There's one little consideration, and that is that you have to have somebody on your tax return that can show 750 hours of work in the real estate field. And that could be as simple as maybe somebody in the family is a realtor, or perhaps you can actually keep a logbook like we used to do with mileage back in the day. And you keep a logbook that every time you are doing marketing, every time you are doing landscaping, every time you're visiting, again, you just need to be able to show that 750 hours should it ever arise. And Steve, we haven't run into a case where it has, but we always encourage the clients to do such.
We are always talking about having good records. And one of the things that we talk about is with the depreciation, it's wonderful because you have a positive cash flow. So the money that you take in is more than the money you pay out in expenses. You don't write a check to depreciation. Depreciation is a theoretical concept. It's a paper entry. But you have the beauty of a positive cash flow with a tax loss, and you can actually wipe out the profits from that building completely. But then we also get the question all the time, well, wait a minute, I have so much depreciation here that I actually put the building into a tax loss. Can I write that tax loss off against my other income, like dividends, interest, wages, profits from a business? And then we have the lawyer's answer, it depends. And part of what TJ was talking about is if you qualify as something called a real estate professional. And with that, if you're a married couple, only one spouse has to qualify. And if you do that, not only do you benefit from the real property, but you can also save taxes on your wages or the profits from your business, investments. So that's still another area that we look into.
Perfect. Well, if you can see on your screen, there's a chat box. There's also a Q&A. If anybody has any questions, certainly type those in, and we're happy to help. From that standpoint, Steve, from your group, we're always happy to help. That's why we're here. And it's very simple. This is all we need. This is literally all we need to get you a complimentary quote on what you're building, what you're sitting on right now. We simply need the year and the month in which you purchased it. When did you acquire that building? So the month and the year. We need how much you paid for it. Okay. And if you don't know the land value, we can figure it out. But if you do, then a net number is perfect. But how much you paid for it. And then lastly, we need the address. We just need to know where it's located and what type of business it is. So if it's a doctor's office, or if it's a retail strip center on the corner of X and Y and Z, that's really all we need to know. Once we've gotten that, we're usually 24 to 48 hour turnaround with our report. We get that report back to you, and you're able to see exactly what type of monies you're sitting on.
And I'm the founder of our law firm, and I started it over 30 years ago. And before I was a tax attorney, I was a CPA. And the reason that I founded it is I said, the Fortune 500, and that's how I started out, because I have heavy duty tax credentials. And I started out working for a giant firm whose clients were the Fortune 500. And I said, well, that's great for the Fortune 500, but there's businesses a lot smaller than that that could benefit from this, but they just don't know it. So I went into practice over 30 years ago to basically spread the word, and I've been doing that ever since. And my colleagues, attorney Cliff Capdeville, he's been doing this for over 30 years. And attorney Liz Prain, you've heard her voice, but she's off screen. We've been together for many years as well. And we have dedicated our professional lives to saving tremendous amounts in taxes. And also, we all find it very personally satisfying.
To that point, Steve, cost segregation in some form has been around since the 1962 Tax Act, but really it was only the Fortune 500 companies that really took advantage of it. And as TJ mentioned, Jim Shreve with the Hospital Corporation America case really opened the doors for small businesses. And we can help almost any business owner with real property save money. And I can't think of a case where we didn't save a multiple of the fees associated. So question that comes up, TJ, I've got Steve, he's an attorney and who's a CPA. Why do I need to hire TJ? Why can't Steve do this on his own?
Yeah, great question. Well, number one, I think compliance. It's always smart for taking the best knowledge you have and the best information you have and farming that out, because number one, you're compliant. Number two, we know the rules with the IRS in regards to cost segregation, the tangible property rations, the CARES Act. And from a standpoint, the CPAs and tax attorneys we work with, there's so many tax laws, so many, that a lot of times the little things like cost segregation get mixed. So we've developed a good working relationship with each other, simply for the fact that, kind of like yin and yang, we know exactly where we can push the IRS to get Steve's clients the amount of money back. And Cliff, you said the key word, which was multiple. We have found that when in 24 to 48 hours, when we provide back your group their first cost segregation analysis, we call it a pre-analysis. It is, let's just say it's $1 million building, and let's say that there is $65,000 that is what the pre-analysis shows. After we've done a site review, because that's what makes us different, being an engineer based, and that's why we can be so finite with the IRS and get so much more money back. Because of that site review, that ends up turning into that $1 million building $120,000 to $130,000 back. And the keyword was multiple. I cannot think of a client in all of the years that I've done this with the clients that I've had that haven't gotten back close to time and a half, if not double what we originally projected. And that's a huge thing. It wasn't like we went back and said, hey, we got you double, we need to charge you more for the study. It just doesn't work that way. You still get everything that we provide. We just end up getting more money than we should. But when we put out that pre-analysis, we're conservative. We do that at about an 80% valuation. That way we know that if something didn't pan out, we're still going to get our client exactly what that number is. It's on that paper. But again, I haven't seen it where that hasn't happened. It's usually been time and a half to do.
And also another key figure here is evidence. And TJ's firm, they're engineers. So it's not like somebody, even with credentials of attorney, CPA says, well, I guess this is that. It's like valuations. It's like we all know the Mona Lisa is valuable, but just how valuable is it? Mm-hmm. When we have engineers that go in and say, look, under engineering standards, because the TJ's firm is doing analysis, okay, of the total amount you spent you wrote one check for the building, but of the total amount you spent for the building, how much of it's in this category, how much in this category, how much in this category. That's where it's so incredibly valuable, where an engineer comes in and says, yes, I have the evidence to do this. That's why we don't have problems with the IRS, because we have good, solid evidence. This is an engineering project, and that's why our firms work together, because we have the combination of a tax law firm, accountants, engineers, and all one integrated team. And our firms have worked together for many years, and that's a tremendous advantage to a client. Nothing falls through the cracks. Everything's taken care of.
And I think we're both San Francisco Giants fans, so it's got to have a lot to do with it.
I think TJ is referring to the fact that I'm also a TV legal analyst, and I have been working with the Giants for a lot of years, where he's seen me on NBC television giving my legal analysis on Giants and lots of other things too. And I've been on the radio for 30 years as well.
Well, Steve, we're proud to be a partner. We're proud to work with your team, and I know that we're not able to see your face out there, but it literally cost you no money and no time to send in the information to let us look at your property and find out and tell you what you have back as far as cost segregation goes. And again, you may be sitting on far more money than you realize. And why not take a peek at it? And then from that standpoint, make an educated decision to how you want to move forward. But I can't think of anybody who would not want to keep their tax money in their pocket and not give it to the IRS.
I've never in my career, spanning more than 30 years, ever had a client ask me, is there some way I could pay more taxes? Everybody wants to pay less. I've never had anybody say, no, I don't want to save the money.
Yeah, absolutely. Absolutely. Well, I appreciate it. I'm looking at the chat box and the question and answer, and I'm not seeing anything roll in. So I guess that means, Steve, we've done, and Cliff, a wonderful job explaining.
Well, back when I was a professor, that I used to say when that happened, it's been a perfect teaching job.
Years of experience, right? Well, perfect. Liz?
Great. I think you guys did a great job. Thank you very much. And this is recorded, so it'll be available if anybody wants to go over any of the information again.
Wonderful.
And
Thank
you
you,
can
everyone.
also contact either of our firms. You
How
can
do,
contact.
Liz, how do they get a copy of the slides or the presentation if they want it?
Yeah, great question, Cliff. At this standpoint, all you need to do is get in touch with Steve's team at Moskowitz LLP, And once you've gotten them the information that they need, we'd be happy to send this out. And there's also a lot of other slides that we've got, or handouts that we've got too. And if you can see on your screen up to the top right, there's a little handout section, but it's really what we went over. There's Tax Cut Jobs Acts, there's engineering based, the difference between an engineer based firm and a non-engineer based firm. And it's just more finite detail of what we do, should you want to look at that.
And a question that comes up oftentimes, TJ, is client doesn't have any architectural drawings or engineering drawings or blueprints or anything like that. Is it okay? Can they just give us a call and can we get started without that?
Absolutely. We honestly don't need any of that. We do it for compliance reasons. If you don't have blueprints, it's okay. We know when you bought that building, there's an appraisal somewhere, either through the bank or through the land title company, what have you. As long as we've got that and you can confirm the cost basis, and basically that is through your appraisal saying, hey, this is what we bought it for. This is the land removed. Here's our factual number. And then, hey, we stuck another $450,000 worth of improvements in it. So now our true number is this. That is all we need. That is really all we need. All right, perfect. I don't see any more questions coming in. So with that, Steve and Cliff and Liz, thank you so much for allowing our firm to be part of this today. Again, as I mentioned earlier, do yourselves a favor and send in your information. Let us take a peek at it and let us tell you what you're sitting on. It costs you nothing but maybe 3 minutes of your time, and that 3 minutes could be worth $300,000.
Thanks to all, and you can also contact us. We're at your disposal. We want to go ahead and help you. You'll see us on the web. You can email us. You can phone us. And Liz, will you give out our contact information? Or you can call us at 888-TAX-DEAL or MoskowitzLLP.com.
Perfect. Thanks for having me, Steve.
Thanks, everyone.
Thanks for partnering with us.
You got it. My pleasure.
Bye-bye.
Bye-bye.